Metro Brands Quarter 1 Fiscal Year 2026 earnings are out. So let's check out these earnings. So as you can see, we already have some of the numbers available. So 928 stores in total as of uh, Quarter 1 Fiscal Year 2026. We have 628 crores in revenue from operations, 195 crores as EBITDA, and a 31% EBITDA margin. 72% of revenue came from their own brand, so the brand that they themselves own, and there's a 45% in year-on-year growth in e-commerce revenue or revenue from e-commerce sites online. Uh, and e-commerce contributed 13.7%, 13.7% to total revenue, and 20 net stores were added this quarter. Net stores meaning some stores were added, some stores were closed. So overall, stores added minus stores closed, 20 stores were added overall. Moving on, we have how did this quarter do in comparison to 12 months ago or the Quarter 1 Fiscal Year 2026. So this is standalone. We also have the consolidated figures, but they are pretty much the same. There's not much difference. So we're going to look at standalone figures. So revenue, okay, let's look at consolidated. Consolidated should be more accurate. Okay, revenue 628 crores, a 9.1% growth. EBITDA grew by 8%, now standing at 195 crores. EBITDA margin declined a bit from 31.3% to 31%. Profit after tax increased by 7.1% to 99 crores, and profit after tax margin stood at around 15.7%. Here we have some commentary as to the results and the reasons for these results. So, first reason we see, or first statement, Quarter 1 Fiscal Year 2026 delivered stable growth due to increased demand from a higher number marriage dates. Okay, but this was partly offset by Eid, preponement to March, early onset of monsoon, and geopolitical tensions. Okay, a higher number of marriage dates. That's interesting. 23 new stores were opened. Earlier we saw 20, but I guess net store addition. So 23 stores were opened overall, and this was offsetted by 3 stores closures for the quarter. We saw e-commerce sale, including omni-channel, grew at 45%, contributing to 13.7% of total revenue, as compared to 10.4% in Quarter 1 Fiscal Year 2025. Okay, and EBITDA margins were lower primarily due to higher marketing spending on brand building and positioning. So I guess more brand spending, higher marketing spending is obviously a long-term investment because brand building is so important. So EBITDA margins were lower only due to that reason. Moving on, we have some more deep data. Yes, year-wise store additions, and we have the latest one. Now we already saw 928 stores and 20 were added overall. 20 net store additions and 928 as of now, the latest data we have. Then we have the stores by which brand. So Metro Brands has multiple brands. Okay, so the top number we have is Metro. Metro Brands. So Metro, the main brand, has 350 stores and they added around 5 from end of fiscal year 2025. Then we have Mochi. Then we have Mochi brand. This has 265 stores and increased from 256 stores. The third is Walkway and the fourth is Crocs. So Crocs increased from 219 to 221 stores and Walkway increased from 70 to 74 stores. And then we have the rest of them and they have remained basically the same. So moving on, we have one last data set to see very important or could be important. Okay, first, uh, revenue contribution by brands. So these percentages show the revenue contribution by their own brands or third-party brands. So Metro Brands sells products by their own brands and even other brands like Crocs. Crocs is not Metro Brands' own brand; it's a third-party brand. So in quarter one fiscal year 2026, 72% of revenue came from their own brands and 28% came from third-party brands. Then what is this? This is revenue segmentation or how revenue is divided according to gender and kind of age. So 32% of the revenue came from men or products for men, and this is a declining percentage. Then we have women. 40% of revenue came from shoes, I believe, or products for women, not just shoes. 13% of revenue came from kids, and that's a big increase. So it seems that revenue for kids, here we have kids. I hope that's the same color as this. Never mind, that's not for kids. That's unisex. Sorry. Is that kids or is that unisex? I think that's unisex. So for both genders, products for both genders by default, 13% of revenue, and it's an increasing segment, very highly increasing. Then we have accessories standing at around 12% and kids 3%. So dominated mostly by women products for women 40% and 32% men. Then product pricing sales mix. What percentage of the products were at what prices? Okay, now this is interesting. So 56% of the sales came from products with a price of more than 3,000 rupees. I think so that's what it means. So 56% of the sales were from products worth more than 3,000 rupees. 33% of revenue came from sale of products worth between 15,001 rupees and 3,000 rupees. Then 6 and 5%, smaller one, is like 500 to 1,500 rupees. So majority of the revenue comes from products selling at more than 3,000 rupees. So very like premium products, we can say. What else do we have? And this is the okay average realization. So I think this is price per product. The average realization that they get from a customer, it's 1,575 rupees. I don't exactly know what this number means, but I guess if you do know, the viewer, if you know what this means, then very nice. And they're targeting the mid and the premium segment. Okay, mid and premium segment at average realization, it's constantly increasing. So what can average realization be? Price of one product maybe? I'm not sure of how much money customer on average on like one visit they pay. I'm not exactly sure, but it could be that. It could be that. Yeah. How much money does one customer pay on like one visit? Uh, or price of one product, like per product? I'm not sure. But average realization, it's increasing. That's good. Overall, we saw 9% revenue growth. EBITDA growth was lower. Why was it lower? We saw that there was higher marketing spend and profit after tax was even lower. So is that a concerning thing? Is that something one should look towards? I don't know. I think that's it. If you want to look at one more thing, we can look at like this. The profit and loss consolidated. Here we can see the more direct figures as to why. Okay, yes. So we're going to focus on quarter one fiscal 2026 and quarter one fiscal 2025 figures. So revenue we already saw, and we already saw total income, 657. That's the total income. So income from income from other sources. So we're looking at the expenses. Purchases of stock in trade increased from 206 crores to 309 crores, a massive increase. Employee benefits expense rose from 59 to 63 crores. Other expenses rose from 103 to 116 crores. I think this may include marketing costs and change in inventory of stock in trade. Ooh, it was a positive 20. Okay, sorry, that's a minus 7, minus 53. So it's not a cost. This year was positive. But this quarter, the change in inventory of stock in trade was actually positive. So it added, yeah, this must have added to revenue or added to profit, basically. I think that's it. Yeah, pretty accurate, I believe, then, that marketing expense was the reason that EBITDA was actually lower. And I think that's it. That's it. Yeah, that's it for the video. Have a nice day.